In this video, I'm going to teach you how to put the 15-minute opening range breakout on steroids using Orderflow and gamma exposure. So usually what we do is on the 15-minute time frame, we wait for the first 15-minute candle to close. So that would be the 9:30 a.m. 15-minute candle, which is right here. Now, ideally, when we have a candle on the 15-minute time frame, like usually what we do is let's just mark it out like this. Okay, cool. We have the first 15-minute candle, right? 15-minute high and 15-minute low. We mark that out. And then on the lower time frame, what we wait for is for price to either break out to the downside or to the upside. So usually when that happens, right, for example, we get a breakout above the opening range, we take a long. But most of the time, what happens is price just starts consolidating or it just reverses, right? And most of the time, this breakout can happen and work out, right? So how do we know that if this is a valid breakout or it's a fake out, right? Because yes, statistically, this is also like in the papers of the institutional strategies, right? And this strategy is backed by over years of data that it is profitable than just holding S&P. But what we can do is make the win rate even increase the win rate even higher, right? So usually we use the gamma exposure and the gamma environment to know whether we're going to get a valid breakout or we're just going to get a fake out, right? So I use the platform called MentorQ, and it just gives me the regime for the intraday, right? So are we in a negative gamma regime or a positive gamma regime? When we are in a positive gamma regime, what usually happens is we see a balanced price action and we see like price chopping around, right? It's like a balanced price. So the dealers are forced to hedge against the price. So for example, if the price is going up and it taps into a key level, they will be forced to hedge against the price. So they will be forced to sell, right? Or hedge, in other words. So that is positive gamma regime. Now, the positive gamma regime is not suitable for the opening range breakout strategy. What we need is a negative gamma regime. So when we have a negative gamma regime, right, that's when the dealers are going to buy if the price is going up, amplifying the movement, right? So the movement will be stronger. So if we break above our resistance levels, that breakout can hold, right? So when we are in a negative gamma condition, it's a breakout type of condition. And when we are in a positive gamma regime, it's a failed breakout, like a fake out market condition, right? So in a positive regime, usually what will happen is when we break above the 15-minute opening range, we're just going to consolidate. And then there's a very high chance that we're going to reverse and we take out the low and bam, 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 like that. However, in a negative gamma regime, what we can expect is when price breaks above the opening range, the dealers are going to be forced to hedge with the price. So they will buy as well when the price is going up, right? And basically, we get this information with MentorQ or other tools out there. Of course, I use MentorQ. If you want to get this, you can get 30% off. Link is in the description. But pretty much that's what I look for on MentorQ. And then on the charts section, I have the real-time gamma regime. So it updates after every 5 minutes. So just before the opening range breakout, we can see if we are still in a negative or a positive gamma regime. So for example, and these are the gamma levels, right? So if we have 1 day max, we have the call resistance, we have G2, G1, HVL. Now, let's assume that we get a breakout above the opening range, the first 15 minutes, and we have a gamma level resting around here. So that could be your draw, right? This is your liquidity. So you can target that level as your take profit. Now, that is the part of how we use the gamma environment to our advantage, right? So we only take opening range breakouts during the negative gamma regime. Now, here comes the fun part, right? What we're going to use is Orderflow to confirm our entries even further, right? So I'm using deep charts, and you can use any other Orderflow tool out there. But personally, I use this because it's just so good and everything is user friendly. So what I use in this indicator is an indicator called, let's just remove this. If I go to the indicators, I use an indicator called big trades, and it's basically showing me big trades where the big players are present, right? So what I do is I set the threshold to 60, then I change the setting to text, and then I have it set at 80 and 80. It's minimum and maximum opacity, right? So essentially what is this showing me is, like, if you see these boxes over here, right? 321 sellers, 60 sellers, 250 buyers, right? 87 buyers and all that stuff. Now, what I'm looking for is, first of all, we need to be in a negative gamma environment. And let's assume that we, on the 1 minute or 2 minute time frame, we get a breakout above the opening range on the 1 minute or 2 minute. Now, on top of that, what I want to also see is aggressive buyers stepping in that caused this breakout. If there are no aggressive buyers present, it's very likely that this is not a strong breakout, and there's still a chance that this could be a fake out, right? So we can reverse and potentially break out of the low, right? So again, what I use with the order flow is I look for aggressive buyers stepping in on the way to the breakout. And when we get the breakout with aggressive buyers and we are in a negative gamma regime, basically in that regime, the dealers are going to hedge with the price. So if the price is breaking a level or going up, they will be forced to hedge their positions to the upside and buy and buy and buy, right? And that's going to amplify, it's going to give more volatility to the markets. It's going to be a volatile breakouts, right? So these are the prime conditions. Now for our stop loss, since we are in a volatile market condition, you need to have a wider stop rather than a small stop loss. So what I usually do is I use a volume profile on the first 15 minutes, so on this, and I put my stop below the VWAP or below the point of control, right? So that way I'm safe. Or what I can also do is just put my stop below the 0.5%, so around the halfway here from 0.75 to 0.5, because price can come back, retest this, and then go up. So I need to give it some breathing room. So around here, that is a valid stop loss, right? And again, for our targets, we can target the gamma levels, or we can target some buy side or sell side liquidity. So pretty much a very solid strategy. So now I'm going to give you guys some examples, some mechanical strategy that you can use, and it just puts the opening range breakout strategy on steroids. Let me give you guys some examples, and then everything would be clear. All right, guys, so here is example 1, and today we are in a negative gamma regime. At the time of this opening range breakout, we were in a negative regime. We did shift into positive somewhere around here, but then now we are again in negative. But when we were getting an open range breakout trade, we were in a negative gamma regime. So that is step 1, right? Now I have the first 15 minute marked out. So as you can see, the time on deep charts, which is the order flow tool, it's 8:30. So it's 1 hour behind. The actual time is 9:30, but it's just 1 hour behind according to this time zone over here. I hope they fix it. But first of all, we have the first 15 minute candles, right? So I have marked out the high and the low. So now let's drop down to 1 minute time frame here. And now, right off the go, I'm not able to see big trades. So again, go to the indicators, big trades, and you should get this indicator. And of course, if you want to grab deep charts, there's a link down in the description. You could get 25% off. It's a huge discount, a specific deal that I made. So again, I'm going to enable the big trades here. So now I have some context, right? So when we attempted a breakout above the opening range high, you can see that the sellers got absorbed, right? So they were, the buyers got absorbed, not the sellers. So we had a lot of aggressive buyers. So 114, 140, and then in this bearish candle, we had 60 buyers and then also 99 sellers, right? And so you can see we couldn't really break above this. Now this could also be in your entry, but again, we are looking for breakouts, right? So when we see aggressive seller closing below the aggressive buyers, this could have been a short position. But usually we have to wait for like a breakout for this strategy, because we want to keep things mechanical. So here what you can see is we had this breakout on the 1 minute with 60 sellers in the body of the candle. So when the sellers are in the wick like this, that is not a follow through. They are being absorbed. But then suddenly we see this big bearish candle with 60 sellers inside it, right? Now, for my stop loss positioning, what I would do is I would pretty much have, since we have broken out and then we went down here, probably a better entry would be at the retest of this opening range, right? My stop loss can go somewhere around here, right? And I can pretty much just target 1 to 1.5 or like even like 1 to 2 if I want to. And around the 50% of this range is fine, right? Because we have this high, and then of course we have these aggressive sellers that would support the price down. So you can see we came back and retested this level. So a stop loss even above here would be safe if you look at the order flow, and this would have given you 1 to 2, 1 to 2.5 with ease. So again, negative gamma regime. So that means that we can get a valid breakout of the opening range, and then of course we confirm the breakout with aggressive sellers on the order flow. And again, you don't necessarily need order flow. If you don't have it, you can use just the breakout and use the mentor queue. And pretty much if you are in a negative, you can just take opening range breakout trades, right? So let's move on to the next example now. All right, so here is example 2, and this happened on Friday, right? So we have the 9:30 15-minute candle. We were in a negative gamma regime on Friday, right? So let's mark out the high and the low of the first 15-minute candle after the market open. Now let's drop down to 1 minute time frame. Now let's go back on the 1 minute, and you can see that the breakout played out, but how we would have confirmed it with order flow, right? So let's enable the big trades indicator, and right off the go, you can see when we got a breakout with 63 buyers, that is a valid breakout in my eyes, right? Now, again, most of the time, what happens is price, before starting the main move, price tends to come back and retest the broken high of the opening range, right? So what you can do here is take the first trade like this. So this could be a low risk trade, right? And then you can put your stop below these aggressive participants, and you can potentially like hold for 1-to-1 or something like that. But this would have been a break even if you are going for like a long and you're going break even at 1-to-1. But the real entry just appears around here. So I can see the sellers retesting this level and not able to push below this level, right? And then of course, when we see some aggression of buyers stepping in here, so 127 buyers, 61, 62 sellers being absorbed, right? We can take pretty much our long position right here. We can put our stops right below these aggressive participants, right? And then we can potentially just take the move to the upside. So you can see how when we are in a negative gamma regime, the move amplifies. So when we get a break, right? You could have also played it this way. So you could have taken a long on the first trade right here, right? And if you are like aggressive like me, you can put your stop below these aggressive buyers, and then you can pretty much you could have held for 1-to-2. So that is a valid breakout to the upside, right? So basically this is like ORB on steroids. Let me give you guys one more example. All right, guys. So here is the final example. And again, on this day, we were in a negative regime as well. And basically I have the first 15-minute marked out. So the first 15-minute candle after the New York Open, right? So initially what you can see is that on the 1 minute, we had a break, but there are no aggressive sellers, right? So we have aggressive buyers in here, aggressive buyers. We have some aggressive sells in the wick area, but ideally the candle that breaks below the opening range must have some form of aggressive sellers, right? Because that shows that there's a huge volume behind this breakout, and that amplifies the move. So in a negative gamma regime, yes, we have a valid breakout scenario, but we need to really confirm it with order flow. So around here, there are no entries because this candle broke below the opening range low, but there were just no aggressive sellers. So we go back up again. And since we can only take breakouts and not mean reverting trades, so we cannot take a reversal and take a long, we are only looking for breakouts because we're in a negative gamma regime. You can see when we break below the opening range once again, that's when we see aggressive sellers stepping in. So 46 sellers in the body. If the aggressive sellers are in the wick area of this bearish candle, so let's assume that there was like in the wick, we had aggressive buyers. That is not a proper aggression. That is sellers getting absorbed. For example, in this fractal moment, we have this bearish candle, but the sellers are in the wick area. Of course, context matters. You can see absorption anywhere, but we need to see it at the key levels, right? And follow through. So with this information that we retrace back up, right, after breaking the opening range low, and then we have, again, a close below once again with aggressive sellers, that, ladies and gentlemen, is going to be your short position. Of course, you can see price always tends to come back and retest the opening range low, right? So pretty much you could have taken a short position at the close here. I would personally do it like that. And of course, I would use the volume profile from this high to this low and see where's the value area high. So I would put my stop somewhere around here, right? Just to be on the safe side. Or what I can do is just put my stop above these aggressive participants in close proximity, right? Just to be on the safe side. And then I can pretty much just take this entire move to the downside. And you can see, since we were in a negative gamma regime, it amplifies the move to the downside. And basically this would have been a banger. So I just wanted to decided to give you like a mechanical strategy that you can use. Of course, you can use this type of logic with any of your other strategies, but the opening range, statistically, it is proven to be very profitable, and it's profitable than holding just S&P. So with this edge, I believe you can be successful, right? And that's gonna be it. So I'll see you guys in the next one. Take care. Goodbye.